Are your emotions taking your investments on a detour? That's the theme of today's annual meeting for the Templeton Growth Fund in Toronto. And we have here Lisa Myers, the lead manager of the fund, to talk about those markets. Welcome back, Lisa.
Thanks, Jonathan. Good to be back.
Now, about a year ago, people were really nervous, and I think a year ago you told us at this very annual meeting that our economic Armageddon had passed us by. We enjoyed a nice rally, but people are getting a little nervous the last few months. Should they be?
Well, I think it's understandable that people are uncertain at this point, and it's natural when you have a level of uncertainty to want to pull back. You did well in 2009, and if there's uncertainty that it's going to continue in a good way, why stand around for it? I think the point is, frankly, that it's important to understand what that uncertainty is emanating from, and then to understand the countervailing forces to that uncertainty, which could perpetuate an environment in which stocks can do well and that the economies can continue on the path that they're on. Furthermore, I think it's important to point out that that uncertainty is generating stock valuations of great companies that have very strong global businesses that are making it very compelling for investors today.
Well, it seems like there's only one good company out there right now, is Apple Computer. Do you own it?
We don't own it, actually, but not because it's not a great company, just because its valuation reflects that it's not a great company. We tend to like great companies that investors are focused on near-term issues or things that are not giving a company credit for being a great company. So we're looking for those ones that are misunderstood rather than ones like Apple that are pretty well understood by the market.
But there are other U.S. big tech giants that are in your portfolio.
Absolutely. In fact, technology is one of the biggest overweights in the fund today, and that's broadly speaking across many very well-known household names like Oracle in the U.S. and SAP in Germany, or Microsoft in the U.S. or Accenture. And we like technology because technology is very indicative of the kinds of companies that we're buying at very low valuations today that have great global businesses that are participating in continuous growth in the emerging markets and that are able to sustain relatively strong growth even in developed markets where people are worried about sovereign debt issues and other things slowing the growth in those markets. In addition, many of those companies have cash on their balance sheets, which enable them to continue to grow their businesses around the world. And they can also give that cash back to shareholders, either through share buybacks or dividends. And as you know, many of them are very acquisitive, and what we're seeing today is that with valuations, again, where they are, we continue to see consolidation in the tech market, which ultimately consolidates their positions and makes them even stronger companies going forward.
Now, of course, so even though you're Templeton Growth Fund, you're really a value fund. It's arguably a bit of a misnomer, historically speaking. But you're finding the value, and you're a go-anywhere fund, obviously. So the mountain chart, so currently is it like a third in the U.S., I believe?
About 42% in the U.S.
And Europe, everybody seems to be thinking with, if you're a contrarian, with Spain and Greece and everything else, that the real value is in Europe. Would you agree?
Yeah, actually, when we look at valuations versus their historical averages, the U.S. and Europe are both trading at about a 35% discount to their historic averages. Having said that, the historic average for Europe is a bit lower than the U.S. So if we look at absolute PE levels today or price-to-book levels, what you would see is that Europe is, in fact, trading at very low valuations. And within that, what we like not only in Europe but also in the U.S. is we're able to buy large multinational companies that may be based in Europe or may be based in the U.S., but that are doing business all over the world and have the benefit of stronger growth in environments other than those developed markets where we're debating about what fiscal austerity may be coming down the pike and slowing growth.
Now, you're the fifth manager on the fund in the 5 decades plus that it's been on there. The last 10 years have been pretty rough for global stocks, generally speaking. I know you've beaten the index over the 10 years, you and George Morgan. What can your unit holders expect going forward the next 10 years?
Massive outperformance. I'm teasing. You know, I think Canadians have to look over the last 10 years and think about what's happened. And I've obviously spent a lot of time doing this because of the headwind of the Canadian dollar for global investors over the last several years. So if we look at performance prior to the mid-2003, early 2004, what we can see are many years of strong outperformance of global markets for Canadian investors. And what we saw was very consistently that global investing was a good diversifying factor for Canadian investors, that it delivered very strong returns. And by the way, Canadian investors, despite the strong Canadian dollar, which have really degraded global returns over the last several years, really American investors and European investors, anyone investing outside of their market has not had a particularly good 10-year spell because of what we've just come through and the market degradation that we saw in 2008. Having said that, what we need to think about is how focused the Canadian market is and how tied and correlated it is to commodities, and how risky it is, frankly, for Canadians to be tied solely to that market. We've seen how volatile commodities can be. We've seen how volatile the Canadian market and the Canadian dollar can be as a result of that. And because we live in this global world today where commodities are so interdependent on what's going on in other parts of the world, I think it's more reason for Canadian investors to really think about investing globally. And even if they are ebullient about commodities and the continued run of the Canadian dollar and market because of that, then they should be enthusiastic about global markets and use their strong Canadian dollar to go buy very cheap stocks outside of their home market.
Last question. I know we're a little over length. Last year you were pretty bearish on bonds. Just wondered quickly, how do you view that as sort of a contrarian opportunity as well?
You know, when we look at, I wouldn't necessarily qualify that I'm bearish on bonds because I'm an equity investor, so I don't spend a lot of time looking at bond valuations. But I have to say that when we look at equity valuations and free cash flow yield, so the amount of free cash flow that companies are throwing off versus their price and what we're buying that consistent cash generation at, free cash flow yields are much higher than bond yields at this point. And when we think about, you know, the world going forward, clearly that valuation disparity indicates that there's a lot more upside in equities today and they're a lot cheaper than bonds are. So we continue to think that equities are a good place to put your money today.
Thank you, Lisa Byers, and good luck at the Roy Thompson Hall presentation today.
Thanks very much, Jonathan. Thanks for having me again.